Welcome back, guys. And we were discussing about technical analysis, and this is our part two of technical analysis. In this, we'll be covering about multiple candlestick pattern. In the last video, we covered single candlestick pattern, in which we covered hammer, marubozu, etc. something. And in this video, let's start with the multiple candlestick pattern. So patterns that involves multiple candles to signal market trend, that is what we are going to see in this multiple candlestick pattern. So often used by experienced trader to confirm market condition, and like it involves series of candles in order to predict the market trend in order to make your view, and that's what we are going to look at. So the first multiple candlestick pattern that we are going to look at is bullish engulfing. So bullish engulfing, you can see there's a candle uh, which is having open close. You can see it's a right candle, and bullish engulfing, that means bullish is that the market is going to go up. So it appears after a right candle, and if you can see this size of candle has already engulfed this particular small red candle. So that is why it's called bullish candle, bullish engulfing candle, where the closing price is greater than the previous candle's opening price, and the opening price of this candle is greater than closing price of the previous candle. As you can see, it has totally surpassed this particular small candle, small red candle. And here you can see after this particular candle appeared, the market moved up because there was enough buying pressure. Like, as you can see, that there was full selling pressure on this side, and after that there's a one bullish engulfing pattern that appeared, and after that all these traders must have entered at this particular closing price of the candle, and after this you would have, and the stop loss would be somewhere around the previous candle's closing or low price. Let's assume that we will have a stop loss at a low price of the previous candle, so we would have made our trade, and 1 is to 2 we would have got somewhere between here our targets, and that is called bullish engulfing pattern. This pattern will fail, as you can see, if this candle, if it would have broken the previous candle ka low. So this pattern would have reversed, and I think it would be downward trend again. Next is bearish engulfing pattern. It's the same as bullish engulfing pattern, just that the this pattern has reversed. We were thinking that the market will go up after the bullish engulfing pattern appears. In this, after a bearish engulfing pattern appears, the market will go down. So you can see in an uptrend market where where there is a green candle, like just the previous candle, where this is open, this is closed somewhere, and in the next candle there's a big red candle, and it has full engulfed the previous small candle. So you can see the opening price of this particular candle is greater than the closing price of the previous candle, and the closing price of the candle is less than the opening price of the previous candle. So this is called bearish engulfing pattern. Just think about it. Don't get confused between the opening and closing. That the previous candles, like it is bigger than the previous candle, and it has fully surpassed this previous candle, this previous green candle. And in this particular kind of trades, you can just put your you can enter into the trade after its closing somewhere around here, and you can do a short position onto this trade with the stop loss of the opening of this closing of this particular green candle. Okay, this is the closing, this is the opening, this is the closing of that particular green candle. So this would be a stop loss, and obviously the pattern would have failed if the red candle would have given a closing above, or this particular next candle would have given closing above the closing of green candle. So this is about bearish engulfing pattern. I told you how to take trades. So this is how, like, more experienced trader look at about the patterns, because Marubozu or hammer, like, you will be able to see it, but most of the time it doesn't give you a confirmation, like a hard confirmation about a trade. But a multiple candlestick pattern will give you a more predictable chance of what is going to happen in the trade. Next, we'll come to the morning star. So the morning star again, like it, these three candlestick patterns signaling a bullish reversal. So when the market is in a downtrend, it makes a doji. This is an indecision candle. After that, the next candle appears to be greater than the closing price appears to be greater than the opening price of the previous to previous candle. So in this you can see the pattern has already reversed. So like one would wait for the confirmation for the next candle that the opening price of this candle must be greater than the opening price of this candle. But a risky trader would have entered the trade somewhere here because he would have seen the morning star formation somewhere around here. So you can see the morning star comes like when it is a downtrend, it makes a doji. It gives you a green candle, so it gives you a reversal sign for that particular trade, and then you can enter into a trade. And I told, and like if what would be the failure of this morning star? If the next candle opens below the opening price of this particular red candle. In this particular case, the morning star pattern would have failed because like now the pattern is not very sure that it's going to go up. So after that, the market went up and you would have made a good profit in this trade. Next is evening star. So it is for the bearish reversal. So it comes at the top where, sorry, market is going full up, then it makes a doji, an indecision candle, and you can see there is a big red candle that appears on top of the this after the doji appears, and this signifies that the trend has reversed and you can short this particular trade. And given a stop loss of 1 is to 2 or 1 is to 3, you would have made a good profit into this trade. So just opposite of the this morning star, this is called evening star. So you don't even have to remember the names of it. You can just analyze from the charts that okay, if there is an uptrend going on, there's an indecision candle, and one red candle appears. That's that particular red candle engulfs the move of both the previous candles. This particular uh, candle is bigger than the bullish pattern candle, and in this particular pattern you can just think about the trade. Okay, now I think the trend is going to reverse, and you with a very small stop loss you can take the trade, and if it goes into your direction you will be making enough good amount of money. So this is about evening star. Now comes piercing pattern. So in you remember engulfing, we were telling that the next candle should fully engulf the previous candle, but in piercing, it should only surpass at 50%, like more than 50 or just 50% level. So it is a two candlestick pattern signaling a bullish reversal at the bottom of a downtrend. So a long bearish candle appears and bullish candle opening below the opening is below the low of candle one but closing above its middle point. So the closing of this candle is above the opening of its middle point, and it suggests a strong buying pressure overcoming initial selling. So when you can see there was a downtrend and there appeared a small piercing pattern, and the piercing pattern so this was the opening of this particular candle, and this was the closing of this particular candle. So it became a red candle, and you can see the opening price of this candle was lower than the opening price of the previous candle. So this is the opening price of previous candle, but this is the opening price of the next candle. But the closing price, so you can see the previous candle closing price was somewhere around here, but the closing price of this particular candle is greater than almost 50% more than the closing price of the previous candle. So this has halfway surpassed this particular candle, and you can see you can take a trade at this particular position with a stop loss somewhere around the low of this candle, and like it would be like in the next candle the low of this particular candle, and it would be a good trade because obviously it's a trend reversal pattern. So an increased volume on the second day confirms the reversal. So you can see the second day there was this huge green candle. So obviously this green candle would have required huge volume because like to oppose a reverse, to oppose the trend, you need high volumes or to make the trend reverse. So in this particular pattern, the trend almost reversed, and it gave you it would have given a good profit if you wouldn't entered the trade. So, and then the evening star, I think I did. No, I was covering this piercing pattern. No? So, piercing pattern, the 50% of the previous candle, and three white soldiers. So, sorry, in the piercing pattern, there is one for bearish candle, that, and there is one for bullish candle. So, in this particular thing. So the piercing pattern can appear on both the sides. So this is about a downtrend where a piercing pattern appeared in the down of a trend. You can say take the same it as in the when the chart is going up, and there was enough bullish candles, and the piercing patterns appeared next. So and it surpasses 50% of that level. So in that particular case, it would have you would have confirmed it at a downtrend. So next we'll be talking about the three soldiers. So the three soldiers is in three consecutive long bullish candles, indicating a strong bullish reversal. So I'll be talking all about this into TradingView, and so like we will be able to head on with the example, so you can get a clear understanding of whatever I'm saying. So, like, this is about three white soldiers. So, three white soldiers is like three consecutive long bullish candles indicating a strong bullish reversal. So, you can see there was a downtrend, and at the bottom of a downtrend, there appeared three green bullish candles. So, because of these three bullish candles, it suggests a strong and sustained buying interest. So, like three consecutive days, if you would have seen it in a daily time frame, in the next 3 days in a downtrend, the next 3 days appear to be green candles, and the stock is trying to reverse. So it signifies it's a strong bullish reversal, and it indicates a consistent upward momentum, and the volume steady or increasing volume supports the pattern. So you can see the volumes here, like in the past 3 days, like it increased compared to all the low volume, and you can see after this, this particular stock would have moved up. So we'll look all these individual multiple candlestick patterns on TradingView to get a clear understanding of whatever I'm saying. Okay, so I'll just yeah. So first we'll look at, I just like this is a chart of Nifty, and here you can see it's a bullish engulfing pattern. So I'm talking about yesterday, on 4th of July, like the previous trading session, I would say. So in this particular thing, you can see it's a green candle. The opening price was somewhere around 24,335, and the closing was 24,347. In the next candle, like the opening was above the closing price, somewhere like almost above 347.5, 347.5, and this was 24,335. So the opening price is greater than the closing price of the previous candle. Okay, and like the closing price of this particular candle is below the opening price of this candle. So you can see it clearly engulfed. You would have taken a trade around here, and with a stop loss of you know some, and and after that you can see, like, in the full day the market went down, and pretty soon for points you would have captured with the stop loss of how many points. Like if you would have opened your trade here, and like 357 to 528, 30 points to stop loss with, and 30 points to target. So I'll just go for short position, and I would have taken the trade somewhere around closing price of this particular trade. Like honestly, I would have taken high price, but like closing will assume, and then with the stop loss of 35 points, we would have made this trade uh, into like 2:1. So 50 points ka target. So the market after this went full down, for the full day. And you would have, like, so it ended up somewhere around here. So not. So I would have exited my trade here. So you would have gotten a profit of around 50 points in Nifty. So this is about bullish engulfing pattern. Oh, sorry. Yeah, bearish engulfing pattern. Then we'll look at what is bullish engulfing pattern. So clearly you can see in this particular diagram, candlestick pattern, uh, after at 2:45, there was a red candle, and in this next candle, there appeared to be a very big uh, bullish engulfing pattern. And for BTST, like we would have, just bet our money that tomorrow the market is going to go up because there appears to be a bullish engulfing pattern, and in the long term we can see the Nifty is going up, and in the weekly and monthly time frame as well, there is no any kind of support. Nifty didn't break any kind of support, so like the opening would be here. Yes. So that was a very good trade. Actually, the stop loss also would be very small into this particular scenario because I would have just set the stop loss at the low of this candle. So on a BTST trade, you would have, taken a risk to reward of 8 is to 1, which is very good, honestly. So 80 points take profit and just 10 points stop loss. So this is about bullish engulfing pattern. Next, we'll look at the example of the morning star. So I'll just go to a stock honestly. Morning star or evening star, whichever we get. In this particular scenario, like there appeared to be two dojis, so there was clearly a full bearish candle and two indecision candle. After that, it went like it gave a like decent candle in order to tell it that it is a morning star pattern, and you would have taken a bullish trade because you know that the like there was indecision in the market, like the market was trying to push this stock down, but there was indecision at this particular time. But again, in the next candle, the candlestick pattern showed that there is enough bullishness on the stock, and like you would have taken a trade somewhere around here, a long position. I'll just take a long position on this trade. So a long position would have given me beautiful 30 points on a stop loss of almost 5 points. So 1 is to 6, like 7 is to 1 car is to reward ratio, which is fairly very good. And this is about Morningstar. Mm, we'll look at some, Tata Motors for because the stock is wallet. Okay, Tata Motors, so it's not. Yes. Mm, yes. Look at this. This is called Evening Star. So, there was a gap down at this particular day, and like the market reversed it, and there was two indecision candle in a bullish pattern. There was like two indecision candle, but already you know that there is a gap down, so there's strong negative sentiment for the stocks. The stock can go down into this particular day, and we got a clear morning star, and this there was two indecision candle, like a hammer and an indecision candle, and this full scenario, the four candlestick pattern together. So this green candle, so you can see the closing price of this candle was around 920, and the opening price was somewhere around 930. So it clearly, engulfed this pattern as well. But you can see overall there was bullishness, indecision, bearishness, and this particular pattern, confirms that this is a morning star, and you can just go onto a sell side, and you would have actually made a good profit into this particular trade, honestly. So on a risk to reward of like, this particular, I'll just set my stop loss 5 rupees, and yeah, you would have captured a very big move that day. 64 points it fell on a single day. So yeah, like that Tata Motors is around 1,000 rupees. So yeah, stock gave a momentum of almost 5-6%. It's a good move. Uh, so now we discussed about morning star, evening star, bullish engulfing, bearish engulfing, and now yeah, these three white soldiers, and after this you can take a trade on this. So we got this as well. So after this particular capture, you would have taken a long position, and this is three white soldiers, and I think I showed you all the patterns possible, just searched randomly. Yeah. So three white soldiers appeared consecutively, and after a negative pattern, there appeared to be three green candles consecutively, and you would have got this beautiful trade with a stop loss of 8 points and with a target of almost 20 points. Risk to reward 2.3 to 2.35 is to 1. And this is about in this multiple candle, this is all about multiple candlestick pattern. In the next video we'll be covering about uh, you know what are the indicators that we can use in the stock markets, and you should actually rely on these indicators, and I'll just look at if there's anything more to come cover. Yes, a perspective of selecting a trade. So recognize prevailing market trends and condition, identify potential trades, look for significant price patterns and formation, assess risk and reward. So like how did I make just when I was telling you about the trades, what would I have done? What was my psychology behind the trade? How would I, how did I put my stop loss? How did I put one second. Okay. How did I put my stop loss, risk to reward? What was my target? So these things, because I have a clear perspective what I have to do, and there is a pattern underlying that I found, whether be it Marubozu, Evening Star, Morning Star, Hammer. So these are the things that you have to, you can just with more experience, looking at the chart patterns every day, trying to find some kind of pattern. Okay, there is a downtrend going on. There can be any sign of reversal, and I can take a reversal trade. There's a full upside. There's an uptrend. There's a full upward moving market, and I can see some kind of reversal, and I can short this particular position. These things you have to make your perspective, look for the patterns, and if you find those patterns, you just don't have to look at the patterns and just sit around and sit for the trades to automatically happen. You have to as soon as you look at the pattern, you should be starting to make your watch list, what you're going to buy, what you're going to sell at what price, and how you're going to execute the trade, what will be your stop loss, what will be your take profits. These are the things you have to learn about trading, because you can obviously for experience you can just look into the markets, but in order to understand something, I'll tell you a truth. Like I was not very much interested into the markets for 5-6 months, even though my friend was trying to uh, uh, teach me stock markets at its best of his ability, because I didn't put my money into this till the time in 5-6 months, and I was honestly I was not even interested what he was usually talking about. This is happening, that is happening. This geopolitics event is going to affect the markets like this, and today we are going to see a down move or an up move, because at the end of the day, I was not trading. So I was like, if there's nothing, so there was no motivation for me to look into the markets. As soon as I put my money behind all of these things, I started understanding, okay, this is a particular field where I can do things, because there's nothing that I have to do. That was my personal reason, that I can just do all these things at any point of time, at any from anywhere in the country or all over the world. So I just need to have a laptop, and actually I can make money from anywhere if I have the capital to. So that is why actually I got interested into this. And first I put my money behind this, and then and obviously I burned a lot of money into this, made a lot of money. But at the end of the day, when I did put my money, then I started recognizing all of these patterns. Then I started, getting then my interest started developing into the markets. Until unless I was, just looking at the trades, I was not even interested listening to him. But then that's what I'm telling you. You need to, you cannot just look into the trades and look into the screen like, okay, I would have taken trade at this position. Okay, this would have gone down. Obviously, you will be wrong. I'm not at all telling that you can't be wrong, and you will be wrong. But setting a very small stop losses and a good take profits, uh, you know, uh, getting interested in doing the trade, and after a particular time, eventually you will find it very easy, because once you have the right kind of psychology that is put into place. Only why people mostly struggle into trading, because they don't, because first of all they'll bring a huge amount of capital into this, and without any particular knowledge or experience, they'll just put their money, and then they will think that, okay, I'll make 10x of my capital. That is obviously not possible in CA, doctor, or in any kind of field. Like, you need enough expertise of a training period of 4 or 5 years. And after that also, sometimes you don't become a CA, you don't become a doctor, you know, and you don't become a successful doctor, you don't become a successful lawyer, and you did put in a lot of money into that particular field, and you have a lot of experience, and you did a lot of certifications into this. But in this particular field, people just expect that they will just enter, in next 2 days, and they will make a lot of money out of it. So that is not going to be possible. First, the market is going to charge you a fees, and the fees is your losses. And the losses is like the losses helps you make in understanding your psychology. Actually, it is one thing that, and psychology, I always mean risk management. Stock markets is all about 90% is risk management. Just try to preserve your capital as much as possible. If the good trades fall into your lap, you will make good money. But if a bad trade falls into your lap, then you have to cut it as soon as possible. There was a saying in the market that, ungli kaat do warna haath kaatna padega. That is so true, that if you are in a, wrong trade, then you can, just exit as soon as possible. But if you don't exit it, eventually you will lose like a lot of capital into a one single trade that you would have making. If you would have taken 10 take profits, and just two stop losses, the two stop losses would have wiped out your capital if the stop losses or the losses are not, are humongous compared to the profit that you have taken. So summarizing entry and exit for candlestick pattern. So the taker strategy is that as soon as you see the pattern, you enter into the trade. That is a risk taker strategy. A risk averse strategy is wait for the next confirmation. So if you are, for example, seeing a morning star, so as soon as you see a morning star, you don't have to enter the trade. Next day you see, okay, there next day another red candle comes, so then it is a confirmation that the trend has been reversed, and then you can take a trade. So a risk averse strategy is taking the trade the next day, but a risk taker would have taken that particular trade at that very moment. That, okay, I'm anticipating a downtrend into this particular market, and I won't be waiting for another day, because I will be losing my chance of booking profits the very next day. So there is risk averse strategy and there is risk taker strategy. But this is what you need to decide about, okay, what you are going to do. But uh, there won't be 30 trading days or 20 trading. For example, there are 20 trading days in a month. You can't expect all the 20 trading days that some kind of trade will appear and you can make money. Maybe it's just 10 days that you can make enough money for the next month, or just 2 days or 3 days. Because the more you will trade, the more your psychology will get affected. I'm not telling you, if you get enough opportunity every day, but try to don't over trade it. That's what I've learned into my journey. Just do like 2 to 3 trades in a day. That is it. Like as soon as you see 3 trades into your account, that is like it for the day. Be it in losses, be it in profits. And a loss making day, in a loss making day, don't do trade again to recover that kind of loss, because in that psychology already you're suffering from a loss and you are trying to recover from that loss. So now your trading mindset will be very much affected, because now you're thinking that now you're not thinking about a good trade, that okay, I see a good trade. Then you would be thinking that this is the trade where I can recover my capital, and in doing that you will actually burn more capital. So in a profitable day, 100% you can do one more trade, but try to control yourself. Trading is a journey, like it's a long journey. Trading will be a long journey, because why I'm saying this, because if you last for 5 years into the market, because of less capital, less risk taking, you will be able to sustain through this journey. And if you have enough experience for 5 7 years, because after 5 7 years you will be knowing each and every pattern, how these particular patterns react, how the market news affects the stocks, how it affects the index, how to spot a gap up, how to spot a gap down, how to take a BTST trade. These kind of intuition will be, more confirmed when you have enough experience into a particular field. You won't be a doctor in 1 month. You won't be a doctor in 1 year. It will take 7 years or 10 years of expertise to do a heart surgery, honestly. So imagine if you have 10 years of experience and you have the capital at your place, like you have 10 lakh rupees of capital, and you know that this is the best particular trade I'm going to get. And through all my experiences that I went through, this is the day I'm going to make money. On that single particular day, you can actually 100x or 1000x your capital. One single trade can change your full life, honestly. But you have to wait for so long. You have to wait, and you have to keep experiencing losses, keep experiencing profits. And after every trade, try to maintain an Excel sheet, that what went wrong, what could have been better things, that why did it fail, why did it fail, and if 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 it was a winner, that why it was a winner. You note everything from day one, and then you can actually learn about you can learn about yourself into trading. You will be able to find you while you are doing trading. So, long trade, put stop loss, short trade, put stop loss. So in a short trade, you put a stop loss which is higher to this, because you are going to, short the market. So you will put a stop loss with the high price, of that, whatever the price you're choosing the trade. For the long trade, you will choose the stop loss below the price that you have taken the trade. And in the next section two, we will, discuss about support and resistance. So, what are the uh, fundamental in technical analysis? Identifying potential reversal point on price charts. Essential. So, what is the importance of this support and resistance? It is essential for setting trade entry and exit points. The application of this is, it is widely used by trader to predict price and movements. So, as you move along with the journey, you will be able to see that support and resistance are the they are the best things you can ever read on chart patterns. Okay, this is a support, this is a resistance, how I'm going to plan a trade, how you're going to set up a trade. So first, let's look at the resistance part. A price point where selling pressure emerges, preventing further price rise. So again, we'll actually go to TradingView for a better. I'll just open a weekly chart of Tata Motors. So yes, in this particular year, I have already marked. You can see the resistance point. So what is a resistance point in this? So you can see somewhere around here, 458 rupees. There, there was some kind of seller that was sitting around here, and as soon as the price went up at 458, this is 2022, April of 2022, it again went down. Again, it tried to break this resistance. Again it came down. Another time it tried to break this resistance, again it came down. So this is resistance that like at a particular price, the at a particular price, the stock price is not going, like the stock price or any kind of index is not going to go up after that point. So this is called resistance. And once it breaks the resistance, you can see, if you're putting so much pressure onto a stock that okay, every time it hits, it's not going to go up. So as soon as it's hitting 2 3 times, it is making this resistance weaker, and as soon as it will break a resistance, then you can take a long trade. So you can see after this particular resistance ka zone, as soon as it broke the resistance ka zone in 2023, April of 2023, so it was almost a year, April 2022 to April 2023, Tata Motors, even, it was in this particular range. The stock was in range and it broke the resistance, and you would have taken a long position on Tata Motors, buy it in a, buy, you would have holded this particular stock, and obviously the returns are quite quite good. So almost it went up 600 rupees from that point. Damn, like wow. I'll just look at the scale of this. Okay, how much percentage did the stock give the return? So in almost a year, it gave 118 percentage, uh, 118 percentage return. So in April, from April 2023 to July 24, almost 1 year and 3 4 months, it gave 120 percentage return. You almost doubled your capital. So you just need to look at the resistance, and what I just like what we just saw it in this particular thing. Okay, as soon as it broke the resistance, uh, it went so high, like, and this is the beauty of support and resistance. So at particular, at you can see the support at this particular price. Every time it's hitting this particular price, it's going, it's going again back. So this is a support, again this was a support, again this was a support, again this was a support, and it took support the last time. So every time what you have to do, you have to buy at support, and sell at resistance, buy at support, sell at resistance, buy at support, sell at resistance. But if it breaks the resistance, why you have to sell at resistance? Because if it doesn't break that resistance, it's going to go down. So, like that was happening into the Tata Motors. And as soon as it broke the resistance, obviously it is same for support. As soon as if it would have broken this support, you would have taken a short trade. So a support, like every time, like there is some kind of buyer, there was some kind of buyer at 388 rupees. So if there was no buyer at 388 rupees, and the stock would have fallen somewhere around 367, 340, 350, well, exit the stock if you have it. That's how you do support and resistance analysis. So in this particular like part we were looking at, it helps in setting profit targets and stop losses level. So example of resistance. So I just give you an example of resistance that I think this is a wrong chart. The resistance was that the price was going up and up and up, and every time it is hitting, there is some kind of selling pressure at a particular price. So what is support? Just now, as we saw in the case of Tata Motors, every time a stock hits that particular price, there's a buying pressure from the down. That like there are enough people that they're convincing the market that this is the price. This is the price of this particular company. We won't force this stock to go any less than this. And at every support, you have to make a buy trade. At every resistance, you have to make a sell trade. Again, I was talking about that day, the example of HDFC Bank, and you can see like in the past couple of days, HDFC Bank is down, and again it took resistance at 1700 level. So at this particular price, again, from last 5 years or more than five, yeah, last 5 years, the stock is, it's not able to break the resistance, and every time it comes at a resistance, it again falls down. Comes at a resistance, again fall down. So this is the price, it's not going to break. Again it tried to break, like it would have lured investors money. Like many of the investors would have entered thinking that okay, at this particular price it is going to break the resistance and it's going to give like 100% return like Tata Motors. But this was a fake resistance, like fake breakout, so this we called a breakout. So as soon as it gave a breakout, the people who were putting a lot of money behind this, they pulled out their money, and all the people caught in between all of this, lost their money. So again, it went up, again it went down. So and support every time it is coming at a 1400 levels, you can see at this particular price, every time the it is coming at this particular price, there's enough buying pressure, like there are enough buyers because it is a good, fundamentally good company. There's like very good management, there's nothing bad happening into the company. So every time at this particular price the stock reverses and it again moves up. So at support, you just need to just learn about this. At every support, you have to buy. At every resistance, you have to sell. If it breaks a resistance, you need to go long. If it breaks a support, you need to short. If it is a break resistance, put a very stop loss. What? Let me explain what I'm trying to say. So obviously, you can see at this particular price, it was breaking the resistance zone. So according to whatever I, taught you, you would have taken a buy trade. But you have to put a very small stop loss, because now that if it reverses, the chances of you losing your money will be very high, because now it is again going to come at 1400 levels. If this pattern, is continuous, the stock is again going to go down till 1400 level. But on the upside, it would have given you, decent 10 percentage return for a, for a longer time frame. If you would have holded this particular stock, it would have given you good money, but with a stop loss, with a small stop loss. And same with the, breaking the support as well. So on a breaking the support logic, you would have taken a short position somewhere around here. Okay, the market is going down, it's not able to sustain at this particular price, but with a very small stop loss, you would have, you would have shorted this particular position, and actually you made decent profit, 7% profit. It broke the support, it went 7% down, it again, came back. So that is what trading is all about. So if it is respecting, what we call it, if it is a respecting the support resistance, that means it's not breaking the support, it is not breaking the resistance, then you can, trade in between. Every time it comes at support, you buy. Every time it comes at resistance, you can sell. But if it breaks, then every time it breaks a support, you have to go short. Every time it breaks a resistance, you have to go long. You would be thinking, why am I repeating this particular thing so many times? Because it is very important, and I think every damn trader knows what is support, what is resistance, and you should know as well. And support and resistance is nothing but in a range if market is moving. So like in uptrends also we can mark support and resistance, and downtrend also we can mark support and resistance. So now identifying, so I told you what are the steps in identifying the supports and resistance. So it may not be a single line. It may be, a rectangle you can be draw. You like, because this, I was trying to make a support line at this particular price, but like instead of this particular line, I would have, given a range, 2 rupees to 5 rupees range. Okay, this is the support zone. I'll just draw a rectangle and show you. So at this particular price, this stock is taking support. So, this was the closing, this was the closing, this was the closing. So every time you see, the market is going low and again it is closing above. Every time it is going low and it's going above. If we would have, taken support at this particular price, we would have shorted this level also. But you can see it is at 2 rupees, 3 rupees. So like you can use rectangles. Instead of lines in order to mark your support and resistance, because it will be some 10-15 rupees ka range for support and resistance. Obviously no one can predict the exact price, if you would have predicted the actual price of support and resistance, you would have obviously made good money, but that is not the truth. So support and resistance comes into range. That's what I'm trying to say. And again, what are the use? You can use trend lines, you can use rectangular zones. So whatever I was using was Nifty, was TradingView, and on TradingView I was using horizontal lines in order to mark the support and resistance. I was using rectangles to mark the support and resistance. So Nifty is, TradingView is a free chart tool where you can actually mark various things. You can analyze chart patterns. It's free of cost. So and most of the industry use TradingView for analyzing chart patterns. What is the reliability? So the a number of time prices touches the level, time gap between touches. So there should be enough time gap between the touches and a number of times a price touch a particular support or resistance. That tells you about the reliability of that support zone. So like in case of HDFC Bank, it was hitting like 3-4 times in a span of 5 years. So like you can see there's enough strong support, enough strong resistance, and you can trade at these particular levels. Like if the market is in a upward direction, if it has taken a support, that means it's going to reverse. You can just take a buy trade from 1400 level, wait till 1700 level, book the profit. Sell at 1700, wait till it come at 1400 levels, book the profit. So it tells you the reliability if it touches the number of times. So the support and resistance level are zones, not precise points. That's what I was telling you about the rectangles things. It cannot be a precise point. It has to be zones. And the more times a level is tested, the stronger it is. Be aware of false breakout, and just we saw in HDFC Bank chart that there was a small false breakout. It lured all the traders that it's going to break the resistance zone, and because of that particular chart pattern, all the good traders must be like because of that particular move, many would have lost their money. So false breakout, there you can see false breakdown and breakouts. That is very very much common nowadays, because all these algorithms make it super easy for it to manipulate the stocks, manipulate the index. So I told you about the realistic setting targets, realistic stop losses, what are the entry points, what are the exit. So actually, if you're trading at support or resistance, it would require a very small stop loss and a good take profit, because if it respects that particular level, you don't have to worry about it going down. So that is what, like, you can actually trade in support and resistance more often than in any kind of chart patterns or using any kind of indicator, because the chart itself is telling you that at the stock is at this particular range, the index is at this particular range. So looking at just the chart pattern, you can see, okay, what I have to do, and relying on indicators, because indicators comes after the chart patterns, not before the chart patterns. So that is why, like, don't rely solely on indicators. Obviously, it's a good way to do your analysis, but don't rely on indicators. Rely on support resistance. So the conclusion: understanding and applying the concepts of multiple candlestick pattern and support and resistance levels are crucial for effective technical analysis and informed trading decisions. By identifying reliable patterns and key price levels, traders can better predict market movements, set strategic entry and exit points, and manage risk to enhance their trading performance. And like actually, I forgot to show you about. We'll take like the support and resistance can be dynamic as well. Here I'm marking the support and resistance. What horizontally. Now it can be diagonal. Let's look at example of BHEL. Look at the stock. Yeah, you can see the stock. So it is in continuous upward movement, and that this is weekly chart pattern. Imagine what will be the daily time frame. Yeah, we'll look at actually daily. Let's see how it is performing. So this stock is performing very good, but let's mark support and resistance. That is not the thing to discuss. No, regression trend. So what did I just do? Like there's a tool and this regression trend. You can just see this. There's a trend, and you can put uh, this. So you can see support and resistance zone here. So this is the support. This is the dynamic support it is taking at this particular price. Every time it's hitting this particular price, it's going up. So you would have, and what is the resistance level? You can see the resistance level very clearly from here. I'll just extend this particular, you know, Okay, so this is the resistance level. Somewhere around here, every time it's hitting this particular level, it's going down. So you can, just mark the support and resistance, and next time it is coming at a resistance of 340. But if it breaks the resistance, again remember, if it breaks the resistance, it's going to go up. If it supports, if it, if it is, just consolidating somewhere around here, you can take a sell trade without a second doubt. So this is called dynamic support and dynamic resistance. So this is dynamic resistance, and this is dynamic support, and this is dynamic resistance. So the price is resisting at this particular time. So this is the day when, election results came and NDA didn't get a lot of majority as the exit polls were trying to predict. So you would have shorted the market at this day, and it was 20% ka candle on a single day. So on an intraday basis, on a leverage of 5x, you would have made 100%. If you would have, traded with amount of 1 lakh rupees on this particular trade, you would have actually made 1 lakh rupees profit. So a 20% on a leverage of 5x would be 100% return. So this is about support and resistance, and dynamic support and resistance is also very clear for you guys. I'll take a falling stock example. Give me a falling stock example here. So Asian Paints. Yeah, the stock. Okay, there's a lot of and there's a lot of analysis going on behind this trade. As you can see clearly. So here, Bharat has clearly drawn the support zone. You can see the market is an uptrend, but as soon as it broke this particular support zone, you can see every time it is going up, it's coming down, it's going up, it's coming down, it's going up, it's coming down. So actually you can looking at the patterns, you can actually mark your support and resistance according to you. It's just that the particular support and resistance should be strong enough. There should be, enough price points that are touching that particular point. So if you can see, there were like 3 4 points touching this particular line, and as soon as it breaks that support area, actually the stock went very low. Again today it's 1.26% down, and in this video I will show you how to, do trading as well, like how to place order in real time market. Uh, so actually it went 8% down from the level it breaks this particular support zone. And you can see in this particular chart pattern, the resistance is at a, you can just draw the resistance horizontally, but you were not able to, you will not be able to mark support zone horizontally, like support, like it was because on a larger time frame, you can see the support zone is diagonal. So in this particular thing, it actually, if you would have shorted this particular stock at this position, 8% was your take profit. So that is it. That is it about technical analysis. If you have any kind of doubt, just feel free to ask me in the WhatsApp groups that I've provided you, and contact to my email, or write me a query on WhatsApp, text me. Feel free to ask about technical analysis, because now we have covered technical analysis according to the chart patterns, and now we'll discuss more about the indicators part, which won't be that much. Let's straight come to a light blue, and I'll give you example of BEL, with doing everything with BEL. So we'll go for buy. So here you can buy or sell the stock, So what I'm doing, so right now, like it is market hours, so I'll be able to place the trades. So when I'm putting a market order, this is intraday. So the this particular trade is going to, you can see the amount it is taking is 84, because there is a 5x leverage. You can trade this stock, five times less the amount than the actual price of this particular stock. So I will go to intraday market, and I'll just put buy, and you can see the order has been completed, because I'm buying the stock at a market price. I'll just do the same stock, but now with the limit price. How to buy this particular stock at limit price? So, like, we'll just go to limit and decide the price you want to buy the stock at. Like, you want to buy the stock at cheaper price. That's why you're, buying it at a limit price. And you can just go ahead and click buy. For example, you want to buy bracket order. You want to put target and stop loss in the same order. You can just head on to target, and you can just put your stop loss, and you can just buy order. So this gives you a privilege of setting targets as well stop loss in the same order. And that is all. That is all from my side. And thank you for watching. Have a nice day. And if you have any kinds of doubt, just please let me know through email or WhatsApp. That is it. See you in the next video.